So good evening, everyone. My name is Mickey Nachmani, Portfolio Manager and Business Development at Basking Wealth Management. I would like to welcome you all for joining us this evening, our clients, as well as our social media followers, and some of you have reached out to us through our website. Thank you very much for joining us tonight. Basking Wealth Management was founded more than 25 years ago. It is an independently owned firm providing customized wealth management solutions for individuals and families, and currently managing over $2 billion. Our focus is protecting capital and building wealth for the long term with the understanding of your complete financial situations. Given the current environment with interest rate hikes, inflation, further disruption to supply chains, and the Russian invasion, which resulted in a very bumpy start to 2022, we would like to share with you today our views on the markets, as well as some specific examples of companies we are holding and the ways we analyze them. Just as a reminder, the content of this presentation is provided solely as an information and general education. Any strategies discussed, including examples which use actual securities, are not intended to replace any specific investment advice, and you should consult with your portfolio manager before you take any further decisions. The event will run till approximately 8 p.m., starting with a 40 minutes presentation, after which we will address any questions. Please use the Q&A function at the bottom of your screen. Joining me on the screen, our speakers tonight, Barry Schwartz, Chief Investment Officer of Basking Wealth Management, and Ernest Wong, Head of Research and Portfolio Manager, as well as Benjamin Klein, Portfolio Manager, who will be moderating the Q&A session at the end of the presentation. So without further ado, Barry and Ernest, over to you.
Yeah, so thank you very much, Mickey. Thank you, everybody, for joining tonight. Because of inflation, the presentation might run an hour and 5 minutes. And I'd like to thank everybody once again for joining. And my father tonight told me that, why would you have this on the same day that the Blue Jays are playing the Yankees? And I told him, you can watch us both. Maybe you can watch the Blue Jay game on mute. And he told me he's going to watch one of us on mute. So if you plan to watch this presentation on mute, I'll give you the quick highlights. As you know, this year has started off really rough, as Mickey pointed out. I want to let our clients know that we've been here before together, and tough times don't last, but tough investors do, and so do great investments, and we have great investments. Here's the Baskin Wealth Management investment team, and I hope we get to meet all of you very shortly in person again, as I'm sure we're all getting tired of these Zoom meetings and webinars. So we hope to see everybody shortly in better times. So I'm just going to get started on the title. It's called Shaken But Not Stirred. If many of you will know that line, shaken, not stirred, it's the way James Bond orders his martini. And it looks like Daniel Craig, the current James Bond, is he's decided that he's done being James Bond. So I think it's about time we have a bald James Bond. So I'm in the running. But in the meantime, I think there's another meaning to the shaken but not stirred, and in terms of investing and how we control our emotions and how we invest for you and your portfolios. Clearly, we're all shaken by what's going on in the world right now. There's the bad news. The headlines seem endless. As Mickey mentioned, COVID. The Russian war, interest rates, inflation, a poor market, it's very tough. But just like James Bond and how he orders his martini, and by the way, I hope to see people in person. I can order both of us martinis. He has a process. James Bond knows what he likes. He orders his martini shaken, not stirred. That works for him. And just like shaken, not stirred, that's the way we have a process of investing. We know that buying high quality companies, holding them over the long term, not reacting to the day-to-day noise, even though it just feels like things are getting worse. That's the process. And Ernest and I are going to walk you through why we think tough times are not going to last, and why we think you have quality investments for your portfolio for the long run. So I just covered this quickly. Obviously, tough things going on, as we know. Today, for example, the inflation number in the US was the highest ever in 41 years. You have to go back to 1980 to see inflation like that. I was a little boy, so I certainly wasn't paying attention to investments. I wasn't paying attention to my G.I. Joe action figures. But we're hopeful that this high inflation has or will peak very shortly. Clearly, the Federal Reserve in the US, the Bank of Canada in the next few days will be raising interest rates as well. This is going to cool the economy. This is going to, in our opinion, start to bring down inflation. And we're hopeful that the current high inflation that we're seeing now will start to ease as we head into the end of the year. Obviously, the ongoing war in Russia and Ukraine is unknowable as to what are the impacts going to be. Clearly, commodity prices such as wheat and oil, natural gas have gone higher. Clearly, there's a lot of uncertainty. We don't have any idea, of course, what Putin wants to do going forward. And it seems at the moment, obviously, an unknowable and tough situation for investors. As a result of the strong economy, of course, we're only talking about bad news at the moment, but we have to go back to why we're seeing this inflation and potential interest rates is because things are very strong. The unemployment rate in the US is near multi-year lows. And you probably know from walking down the street, going into restaurants, retail stores, people can't find qualified workers. So it is a very strong economy. And as a result, we've had these supply chain issues, commodity prices going up, and the Federal Reserves and central banks want to cut interest rates. Raise interest rates. Raising interest rates will cool the economy, but as you can see, it is not very good for stock markets in the short term. So this is what's going on this year, of course. But there's always something to worry about. This is a chart that we share over and over with our clients. And since March 2009, the market has, and this is the S&P 500, it's gone up from about 600 points in the US, the S&P 500 to over 4,000, 6 times since 2009. And you know what? There's a lot of negative things that have happened since 2009 after the great financial crisis. And only in hindsight can we know which is meaningful, which is knowable, which is relevant to your portfolio. When all these bad things happen, it does seem like the world is going to change. It does seem like things are more uncertain. Things are going to be more volatile. But yet the stock market continues to climb. Why? Because we all wake up every day. We want to improve ourselves, improve the lives of our children, to improve our situation. And that leads to rising GDP, rising corporate earnings. And we are always confident in the strength and growth of North America. And we feel that this chart in the next 10 years will still see a lot of negative points on it, but will be dramatically higher. We've been here before. This drop that we're seeing in 2022 is not unprecedented. It's not something that has never happened before. The red dots on the screen are 20% declines in the S&P 500. The green dots are 10% declines. So far this year in the US, we've seen a 10% decline in the S&P 500 and a 20% decline in the NASDAQ. Your portfolios, the way we manage money right now, is mostly tied to US companies. So that's really the relevant benchmarks and indices that we talk about when we refer to your portfolio. I know a number of clients have pointed out, rightly so, that the Toronto market is doing a lot better than our portfolio this year. That's sure. But I will point out that we don't own very many Canadian stocks. As a result, it's not a relevant benchmark to pick. And we'll get into reasons why we don't want to own a lot of companies on the Toronto Stock Exchange. But the point here at the moment is to show you that drops in the market happen all the time, and they recover. No one knows how long and how far it's going to go down, No one knows how bad it's going to be. No one knows how quickly it's going to recover. I can tell you with certainty, and we're going to give you a few examples, that the market will recover well before the headlines improve, well before you think you can see any improvement in any of the headlines. The market will have recovered and won't look back. So luckily, we haven't seen a significant drop in the portfolios. Obviously, we're not trying to minimize this year's pullback, which is ugly, but here is some really horrible times. And obviously, we don't know if there's going to be horrible or worse market performance going forward. But we wanted to point out, for example, in 2020, March 2020, the stock market, as you can see, fell about 30% from February 19th to March 23rd. It was a very quick pullback, but obviously we remember the circumstances. This was the beginning of the COVID crisis. No one really had any certainty about what was going to happen. It definitely looked like the world had changed. The stock market, as you recall, dropped about 30%. Obviously, we were dealing with a panic, a lot of volatility. A year later, the stock market, the S&P 500 was up 79%. These tough times don't last. The stock markets will and always do recover. And we think that will be once again the case in 2022, or hopefully well before 2023. We've shown this slide a number of times as well in presentations. It's about sticking to your plan, staying invested. You would be surprised to see that in any one year, that's the blue line on my left, the S&P 500 has gone up 75% of the time in any calendar year and this chart is going back, I think, about 100+ years. So in 75% of the time, the S&P 500 has a positive return. And you've seen that in your portfolios. Our portfolios went up 3 years in a row, 2019, 2020, 2021. So this is the fourth year, 3 out of 4, it looks like it's going to be down. Obviously, the longer you stay invested, the better odds are that you're going to have stronger returns. As you can see, if you hold for 3 years, there's an 84% chance that you'll have a positive return over that 3-year period. And obviously, as we look at longer, 10 years, 20 years, it's nearly impossible to have a negative performance in your portfolio over those long periods of time. And of course, the average 10-year returns on the S&P 500 are 10.4% a year. So we're going to stick with those odds instead of trying to time what the market's going to do this year and how bad it's going to be, and if it's going to be worse going forward. We feel the best approach is to stay invested for your portfolios. This is one of our favorite charts as well. We show it a lot. The one on my left shows the growth of $10,000 since 1980 invested in the S&P 500. And the green line is you just stayed invested. And the yellow, blue, dark blue, and black is if you tried to be cute and tried to time the market or get out of the market before bad stuff happens, or maybe you're waiting for good things to happen before you get back in. It's so crazy, but if you only miss 5 days, the 5 best days in any calendar year in the S&P 500 since 1980, you've missed pretty much half of your return in that year. Of course, you could say the same thing about missing the worst days, but what I showed you before on the chart prior, that if stock markets generally are higher over the long term, you're best to stay invested. So generally speaking, the bad days, the good days follow the bad days. They don't follow them in a straight line, but clearly the bad days and the bad months that happen, there'll be a recovery and you can't miss that. And since the future is unknowable, at least it is for us, we believe the best approach is to stay invested. Now, if you think you can time the market, I'm pointing out to you the chart on my right here. It's nearly impossible to do that. So a client reached out to me the other day and he said, Barry, things are really lousy. Why don't we just get out now? Why don't we just sell a good chunk of our stocks now, wait for the 20% drop, and then we'll get back in? my answer back to him was, sure, I don't think that's possible. I don't know, for example, that stocks are going to fall 20% from here. And then, of course, if they do fall 20% from here, I don't know which ones to buy back in. I don't know when I should buy back in. And of course, we don't know which ones to buy back in. So we feel that the best preparation for a tough market is to own good quality investments and unfortunately suffer through the bad times to get to the good times, instead of trying to time the market, trying to pick which stocks to sell, which stocks to buy, or selling the ones that aren't working today to buy the ones that worked a few days ago, and then flip-flopping again when that doesn't work. You can see how mind-numbing and tough that is, but we're going to stick with the strategy that got us here. And so we're going to continue to order our martinis shaken, not stirred. So I talked a few seconds ago about the market recovering well before the headlines improve. I'm an old enough veteran of investing that I was here working with David Baskin in 2008 during the unfortunate great financial crisis. It was not a very fun time for any investor, as well as a younger portfolio manager like myself, but that was a wonderful introduction to the ups and downs of the stock market. You can see that in 2009, excuse me, March 2009, the stock market bottomed. The S&P 500 hit its lowest level of that crisis in March 2009. The housing crisis did not improve until about 2011. So almost 2 years after the implosion of the housing market that really brought down markets all around the globe, housing situation in the US did not improve till 2011. So if you would have said to your portfolio manager at the time, Barry, David, let's wait till the housing market situation improves before we do anything with our portfolio, well, you would have missed a gigantic recovery, because 2009, the market was up about 30%. 2010, same thing. And 2011, also a good year. So just pointing out that it's very tough to time the markets. I'm going to drive the point home a little bit more, of course. The great financial crisis of 2008, the housing crisis, we're looking at the US unemployment rate. The US unemployment rate peaked at over 10% in I think late 2010, early 2011. You can see that things didn't get worse in 2008. They started to get dramatically worse in 2009, 2010, and didn't peak until 2011 when that unemployment rate started to slowly dip. So if you would have once again said to your portfolio manager, wow, people are losing their jobs left and right, I'm scared, let's blow out the portfolio, let's try again, let's wait till the unemployment rate starts to come down, once again, you would have missed a dramatic rally in stocks well before the headlines improve. And of course, going back to a little more recent one in 2020, you might have said to your portfolio manager, geez, the COVID cases are getting worse. Obviously very concerning. I don't know what's going to happen. We all know there was no vaccine announcement until about November. The numbers were increasing every day, obviously very scary, and clearly the numbers aren't improving in today as well. But had you sold stocks waiting for COVID to go away, we all saw that chart where the S&P 500 went up 79% from the bottom of March 2020. So why do stocks bottom before the headline improves? The bottom line is the market is a pendulum. It is always swinging from, as we know, from fear to greed and fear to greed. And maybe in 2021, stocks got overly greedy, got overly expensive, and we swung too far to the one side. Maybe now we're swinging too far to the other side. So the news doesn't have to improve. It just has to be less bad than what is already priced in to the market. The only problem is no one knows what's already priced into the market. But when things are bad, the market already falls. So we're hopeful that the market, that investors at some point, very shortly, will start to discount all the bad news that is currently out there in the market and maybe start to look for improvements going forward. And like I said, you won't see any improvements, but you'll see the stock market start to tick higher. we're right now, as you know, in an environment where interest rates are clearly going up. The Bank of Canada is going to raise interest rates by 50 basis points. I think the announcement is tomorrow. The US is also probably going to do the same in May. And the Bank of Canada is on track to raise interest rates by 1.5% this year, maybe more. And same with the US. There's only one problem with predicting that. Everybody thought interest rates were going to go up every single year since 2003. So that's what we're looking at here on this chart. If you can see these little dotted squiggly lines, that shows the expectation from surveys of professional forecasters. These are the people who go to school to become professional economists, who know who study economics for a living, study trends, and yet you can see pretty much every year, even in 2008, that they thought interest rates were going to go up. And of course, look, the thick blue line is what actually happened. So we do think here that interest rates are clearly going to go up in 2022. But I would take anybody's survey, anybody's forecast with a grain of salt. So why are we sticking with stocks when things are really tough? This is something we call Tina. It's not Tina Turner, but it's Tina in the sense that there is no alternative. And what we mean by that has to do with interest rates and inflation. So you can see that inflation is the red line, was bumping along about 2% for many parts of this 10-year period, and then spiked higher as we saw. This is only going to March 17, but if I ran it obviously for one more month, it would be close to 8.5% as of today. That's the inflation number. The black line is the nominal inflation, nominal interest rates. That's the interest rates that you get when you leave your money in the bank or you buy a GIC.
Yelling.
Yeah. So that's the interest rates. And of course, these interest rates, clearly, they're not getting paid very much when you're leaving money in the bank or getting buying GICs, for example. But after inflation, after taxes, this is what you call your real interest rate. Your real interest rate is the nominal interest rate. So what you're getting in the bank, maybe 1%. And the real rate is in nominal rate minus inflation. So if you're getting 1% on a GIC, but inflation is running 8%, your real rate is minus 7%. I don't like those odds. I don't like investing in products or sitting on cash where I'm certain to lose 7%. Now, of course, we do think interest rates are going to go up. We do think inflation is going to start to come down. But still, if we think that in a year from now, we're getting 3% at the bank and inflation is running at 4%, our real rate is still minus 1%. That is not an attractive outlook. We'd rather invest in companies that have pricing power and growth. So I'm not going to spend too much time on inflation because we've already talked about it a lot, but we can see that there's no question inflation is high right now. There's very serious concerns. The Federal Reserves, the central banks are fighting it left and right. And we do think that at some point inflation will start to normalize back to where it was the prior 10 years. Why? First of all, technology has made our lives a lot more productive. It has certainly made things a lot cheaper. Someone no longer has to travel for a business meeting. They can now do it by Zoom. That saves a lot of money. So we can see the improvements of productivity. The aging population around the world puts a demand on for safety and bonds. That helps to keep interest rates and inflation low. And of course, a final point is we think the big ticket item spending that we saw over the last couple of years is really going to start to slow. So you can imagine that the last couple of years, no one can travel. So people decided to possibly renovate their house. No one could travel. So I guess the logical thing is let's buy a cottage. But ultimately thinking those kind of big expenses will start to slow. You probably can only renovate once or twice. I know that with me and my wife, if we can't keep renovating, or we will not have a marriage any longer because we'll keep fighting. You can't buy a cottage every single year. And as the world reopens, hopefully we'll start to travel more. We're clearly seeing demand for travel increase. So the spending on new cars and new boats, new TVs, new cottages, that will start to slow, and that will start to filter into lower inflation into the economy. A lot of clients have reached out to us and asked us about commodities. No question, they've seen oil prices go higher, potash prices go higher, copper prices go higher, a lot of metals that have to go into EVs, electric vehicles. Those commodity prices have gone higher, and it's been a wonderful time to invest in commodities. The only problem is commodities are very much boom bust. So you can see from this chart that you can have a good period and then a horrible period, and then a good period and a horrible period. And because those companies are very much, they have no control over the pricing of the products that they sell. And of course, the surest way to hurt commodity prices is to have high commodity prices. If oil spikes too high, if copper spikes too high, if lumber spikes too high, then people stop spending money on those inputs. Oh my God, it's a fortune to build a deck because lumber prices have gone up. I'm going to cancel that, or I'm not going to build a deck. Low-income families that were thinking of maybe taking a summer driving trip, well, gasoline prices have gone up 30%. Maybe they'll pull back on that. So the surest way to impact commodity prices is to have high commodity prices. So we prefer to own high quality companies. We are not interested in the boom bust of commodity businesses. We're interested in owning high quality companies. And you've seen us mention this before over and over, and certainly your portfolio manager has, I'm certain, told you that we invest in businesses that have moats, that they have unique competitive advantages, companies that have tailwinds to growth. We like to buy companies like Apple or Google or Amazon or Facebook, companies that are still growing and have big potential to sell you more products and services, companies that have good culture, companies where management continues to run the business or owns a lot of shares like you, companies that are smart about capital allocation. We're not just buying a company because it has a dividend. I want to buy a company because paying the dividend is the right thing, or buying back stock is the right thing. And of course, we much prefer to buy a great business at a reasonable price than to buy a lousy or mediocre business at a great price. And the proof is in the pudding. Over the long term, quality stocks, the companies that have those characteristics have outperformed. And we call those companies price makers. Price quality stocks are generally companies that have recurring revenues, that have pricing power, that sell products and services that you can't switch away from. We're running this presentation right now on Zoom, but I could easily run it on Teams. So I'd prefer running, but there's not a lot of options. So you obviously can't run your business without Microsoft. I can't run my life at home without Apple products. So those are the types of businesses we prefer to own. And just a couple of examples before I hand it over to Ernest. We prefer owning companies that have recurring revenues, pricing power, inflation protection. Visa is a great example of that. Visa went public in 2008. Not a great time, of course, but right after the stock went public, as you can see on the left-hand part of the chart, my left-hand part, the stock dipped dramatically and then went straight up, then dipped and straight up. And you can see that the chart, even though there's been major pullbacks, it has earned 23% per annum per year, not each and every year, but compounded since its IPO in 2008. Those are the types of businesses we want to own. Had you put a good chunk of money in the Visa IPO, if you put $10,000 in the Visa IPO in 2008, you'd be sitting with multi-hundreds thousands of dollars in Visa stock. And hopefully you didn't sell along the way. Or you can own a company like ExxonMobil. ExxonMobil is a commodity producer. It has no control over the price of oil that it sells. it has to spend billion dollars a year searching for new oil, replacing reserves, buying other companies so that it can keep its production at the same it was the prior year. And only up until the last 6 months has Exxon even earned you a positive compound return going back, I think this, correct me, Ernest will correct me later, but I think this is going back to about 2004. So almost 20 years, you've earned 5% a year, and only if you held it until the last few months. Prior to that, you would have been deeply underwater. And Exxon, at one point in time, was the world's biggest company, was the biggest company on the S&P 500. So this is why we don't like to own commodity stocks. And the reason why is we're long-term investors. We think our approach is thinking and going out 5 to 10 years. What's happening right now is sentiment change and multiple change. That's 1 quarter and 1 year. That's what drives the market in the short term. The sentiment was amazing in 2021. The world could do no wrong. No question we were in COVID. No question there were concerns at the time, but the stock market kept going higher. Everybody was excited about growth. Everybody thought stocks were cheap compared to the growth we were going to see. People were talking about this decade being the roaring 20s again. COVID was going to go away and we would be traveling and spending money like crazy. That was the sentiment change. And the multiples, as a result of low interest rates, people paid more for stocks. Now that's reversing. The sentiment is negative. No one can do right. Because of higher interest rates, the multiples on stock, what people want to pay, has been depressed. This is rinse and repeat, guys. This happens all the time. Sentiment flips from negative to positive, multiples flip from paying up to not paying for anything. We got to ignore that approach. We got to focus on what works over the long term. And that's the reinvestment opportunities and the right culture to grow. That's what Visa has. Visa has reinvestment opportunities. It doesn't have to spend the same kind of money that Exxon has to spend to grow its business. Its capital, its investment is people and computers, not drilling and making acquisitions. And over the long term, the right people, the right culture is what's going to grow Visa. Exxon can have great people and great culture too, but pretty hard to drive investment results when you have no control over the product that you sell. And with that, I'm going to turn it over to Ernest. And Ernest, you're gonna hop in right now.
There we go. Got it. Thanks, Barry. So if we want to own good businesses, what do we not want to own during periods of high inflation? First, we don't want to own businesses that can't raise prices with inflation. A recent example is the Frito-Lay company. So in my house, I have 2 young kids and they eat a lot of chips. A few weeks ago, Loblaws decided to stop carrying Lay's chips, including Doritos, Ruffles, and Cheetos, and it caused a lot of pain in my household. And the reason that Loblaws did this was because Lay's asked for a price increase to cover higher potato prices and transportation costs. Now they've since settled, and today you can buy Doritos at Loblaws again, but Lay's is a good example of a business that doesn't have pricing power. They can't raise prices to cover higher costs. Secondly, we don't want to own businesses that have a lot of debt. And by debt, I mean both financial debt as well as operational debt, such as leases. These businesses are going to have to pay more in interest and rent expenses as interest rates and inflation go up. Lastly, we don't want to own unprofitable businesses. If you couldn't make money when inflation was lower, it's going to be even harder when labor costs and input costs are going up. And if I had to sum up all of these 3 factors together, we don't want to own businesses that don't have control of their own destiny. Unfortunately, if we look at our portfolio, I think we're really well positioned going forward relative to the criteria on the last slide. You can see that relative to the S&P 500, which is the indication of the market as a whole, our companies are almost twice as profitable. they have significantly less debt, and they're going to grow earnings significantly faster. And you're only paying a slightly higher price for, in what is, in our view, a significantly higher quality portfolio of businesses. Next slide. And I think this makes a lot of sense if you really look at the types of names that we're buying. We're not gambling on unprofitable fake meat or electric car startups or cryptocurrencies. We own companies like Visa, Ferrari, Amazon, Live Nation, which owns Ticketmaster. These are all large, very established businesses with products that many of you use on a daily basis. Well, maybe not Ferrari, but again, like these are businesses that everybody knows, everybody are clear leaders in what they do. And more importantly, they make a lot of money. And as much as the current losses hurt, if you look back through Baskin's track record, our strategy really does work. This is a list of the 10 longest held positions in our current growth equity strategy. And you can see that all of them have delivered very strong returns, well in excess of the markets, simply from buying and holding good companies through time. Now, I think it's easy to look back and say, well, of course, anybody who bought Apple or Microsoft in 2010 would have done really well. But this really isn't true. It's actually not easy to buy and hold good companies through thick and thin. For example, we bought Apple in 2012, and it has delivered a 28% compounded annualized return since we bought it. But it has not been a smooth ride. Since we bought Apple stock has fallen by over 30% 4 times. And in each time, there were legitimate arguments being made about why Apple was in trouble and why you should sell the stock. In 2013, people were worried that Steve Jobs was dead and that Apple simply wasn't an innovative company anymore. In 2016, which was the year that I joined Baskin, the word was that people weren't upgrading their iPhones as much as they used to. But going back to what Barry said about being a long-term investor should focus on, we knew that most of these concerns weren't going to matter in 5 years, and that Apple was going to sell more phones and outrageously expensive accessories over time. And today, Apple is the most valuable business in the world. So another example of the value of holding through ups and downs that we've owned for clients is TFI International. TFI International is a trucking company that we've owned for clients since 2005. And some of you might recognize their trucks as the ones with, like, you might see them on the highways. Sometimes they have a blue font and a bit of a red swoosh on top. Those are all TFI trucks. TFI is a really diversified business. They not only provide regular truckload services, but they also do things like refrigerated vans for carrying supermarket food, freight brokerage, courier services, and they'll even deliver one-day shipping when you buy something online. Now, the reason that we own TFI is not really because we particularly want to be invested in the trucking business, but because they have a really unique strategy of buying up small trucking businesses and making improvements to make them profitable. So for example, they'll buy new trucks so they can save fuel and maintenance, and they'll raise prices to ensure that every load that they're carrying is profitable. TFI, for example, they refuse to do business with Amazon in the US because Amazon is not willing to pay what TFI considers to be a reasonable price for them to deliver their goods. And TFI, as you can see in the table below, TFI's strategy has worked really well. Since 2008, they've bought over 100 businesses, and their profits have grown quite spectacularly over time as well. I think a more recent example of their strategy at work is in last January when TFI acquired UPS's less than truckload business. And this was really the acquisition, like if you look at the stock price, this is the deal that really made the stock price soar, making it the best performing stock on the TSX. Under UPS's ownership, this business was barely profitable. They were spending 99 cents to make a buck. After TFI bought the business from UPS, by raising prices and reducing costs, they're now making 10 cents every dollar, and they hope to further increase this by 2023. And TFI has done really, really well for us since we bought it. $1 investment in TFI when we first invested in 2005 is now worth over $6 plus dividends. But it's been a really, really bumpy ride as shareholders of TIF International. Right after we started owning the shares in 2005, TFI stock fell by 80% through the financial crisis. And in the 17 years that we've owned TFI stock, there have been 5 other times when the stock has fallen by nearly 30%. But the key is that our focus is on the long-term strategy of the business. We knew that the management went to work every day thinking about how to make more money and improve their business. And ultimately, we did really well in the stock despite the 80% drawdown in the beginning. And I'm confident that a similar pattern is going to happen for all the names that we own today that are down a lot. And with that, we'll turn it over to questions.
Yeah.
Thank you, Ernest. Thank you, Barry. My name is Benjamin Klein. I'm a senior portfolio manager at Baskin, also one of the partners of the firm. Thanks again to everybody for coming out and listening. So just to reiterate how this will work, if you have any questions or comments that you'd like us to respond to, please use the Q&A function in Zoom. We'll answer as many as we can. If history is any indication, we may not be able to answer all of them, but certainly we'll answer as many as we can. And let's get started. So there's an interesting one here. Barry, this one's for you. What is Barry's suggestion in the current environment that an investor should do for the next 2 to 3 years?
Yeah, so thank you very much, Benjamin. And before I answer that question, I want to wish everybody a happy Passover, a happy Easter. If you celebrate Ramadan, it's just like investing, all the roads lead to Jerusalem, and in investing, there's lots of roads to get to Jerusalem as well. So there's lots of different ways to invest, and hopefully we've explained our road to investing. As we talked about in our presentation, our strategy, our style is to really act and think like business owners. I'm a business owner. Ernest is a business owner. Benjamin is a business owner. We're all part owners of Baskin Wealth. And if someone knocked on our door today and said, you know what, guys, I think you got a pretty good business. Oh, the lights went off. Sorry, we're back. I think you got a pretty good business, but I'm going to offer you, I don't know, let's say $100,000 for your business. If I was having a bad day and the market was down a few days in a row, maybe that's a good offer. But I could have walked over to Benjamin and Benjamin said, Barry, you idiot, why would you sell this great business that we have? We think it's going to grow. We think we're going to add more clients. We think we're going to own wonderful investments like TFI and Apple that are going to grow double digits for years. You got to be an idiot to sell. And that's kind of the way you have to think about investing in the public stock market. The wonderful thing about investing in stocks, of course, is the price is quoted every single day, and there's liquidity every single day of the week when the market's open, so you can sell. But the emotional part of it isn't so fun when stocks are going down. So a 2 to 3 year period is very hard to think about when we're living through a tough market today. But the best approach is if you own a great business, don't do anything. Maybe even buy some more. Obviously, we study companies all the time. Ernest's job, the investment committee's job is to come up with ideas, research ideas. But at the moment, we feel like we have so many great businesses in our portfolio that there's not a lot we want to do. No question, we have a few names that are down a lot. But you know what? Some of the other names that we think are great businesses are also down a lot. So why would we sell a business that's down a lot to buy another business down a lot? The only reason to do that is if we think it has a great outlook or a better outlook than what we currently have. And that's really how we trade and how we think about investing. So what's an investor to do for the next 2 to 3 years? I think we're already doing the right things. We own a diversified portfolio of high quality businesses. In our fixed income portfolio, we've tried to protect ourselves from rising interest rates by keeping our bond maturities really short. Obviously, that's not a fun place to be at the moment either. But we think our style, our method, our approach is going to turn around and start working again. And so I would encourage investors, those that are nervous, to take no action, and those that have a very long time horizon, that don't need funds in the next couple of years, they should be looking to put money to work. Ernest, do you have any comments to add there?
Nope. You nailed it.
Great. So this is an interesting one. The IPCC, I believe that's the Intergovernmental Program to Fight Climate Change or something like that, just dropped a report that said people have to consume less and oil companies have to produce less. Does this recent report have any impact on investment strategies?
I'm going to give that to our head of research. All the difficult questions, Benjamin, you can take them or Ernest can take them.
No pressure.
The short answer is no. I think that it may be an issue if you're owning businesses that produce things that people are buying. Like today, for example, like the CarMax, which is the largest used car seller in the US, the stock was down I think it was about 6%, because they said that it was exactly what you said. The inflationary pressures were causing people to buy less cars, right? And I think that, fortunately for us, I think we're really well positioned, because these are businesses that mostly have recurring revenues, they have high margins, and more importantly, they're likely to gain share in bad times. So, for example, Costco's stock has performed really well over the last little bit of time, and they're as impacted by inflation as anybody, but then all their competitors are impacted even more. So then, like, Costco is likely to gain even more share throughout this time. So yeah, I think the short answer is it doesn't really impact the way we are investing.
I'll actually add a short piece to that, which is that we don't, I shouldn't say of course, but of course we don't own any oil and gas producers. We haven't, as Barry noted, for over 5 years. We feel, and this report certainly doesn't erode our thinking in this aspect, that the oil and gas industry is going to continue to shrink over the coming decades, and don't know if it'll be 2 or 4 decades or 6 decades until it shrinks significantly, but it will. It's fighting an uphill battle, like a lot of old industries that are working in an ever evolving and quickly changing world. We don't think that oil and gas is a good long-term investment, just like lots of other commodities. So from our perspective, we don't really think this is likely to change much. It will be more challenging, for commodity investors and more broad-based investors that do have exposure to that sector. Next question. The equity story you have presented is compelling. However, given the expected increase in interest rates, should the portfolio percentage invested in bonds be reduced and the funds directed to some of the good companies you have that have been beaten up over the last quarter?
Great question. Yeah, so this is an awkward year for investors of managing balanced portfolios in the sense that both bonds are going down in price as well as stocks. And the general thinking is, well, you own bonds and you own stocks and you diversify so that if in any one period, maybe stocks are more volatile, bonds will protect you. I mean, I'm pleased to say, although no one is going to give us any high five to hear that our bond portfolio is outperforming the bond index tremendously. That said, it's still negative this year. So I want to just reiterate that we manage portfolios based on a number of different criteria for each client, whether it's time horizon, liquidity, tolerance for risk, emotional tolerance for risk, where they are in their life stage. And no question, in any one period, as we saw, the sentiment for any one asset class can be positive or negative. Right now, it's negative for both bonds and stocks, but that won't always be the case. And bonds do have a place in our portfolio. If you've looked at your portfolio, you've probably noticed, I'll say this generally, that most clients have a higher allocation than they've ever had before to equities versus bonds. And we think that's the right place to be. As I pointed out, remember the Tina Turner, there is no alternative to equities, although the caveat being that some our clients are retiring in a few years, are living off their portfolio, have short-term liquidity needs, And so being 100% invested in the stock market may be too volatile for them. And as a good friend of mine has said, the famous Mike Tyson quote, you can only find out your risk tolerance after being punched in the face. And so a number of clients, and us included, have been punched by the market. And so they may be reassessing their risk tolerance. So, this is a conversation that every investor should have with their portfolio manager at their annual review or sooner to see if they're comfortable with their current asset allocation and have a conversation as well. And I don't want to ramble any further, but Ben, as our head of financial planning, maybe can just add a couple more points to that. Sorry, Ben.
Sure. Yeah. I mean, it really depends on the person's individual circumstances. It sounds a little bit like a cop-out answer, but it's not. If you are a person who, just to throw out some numbers, let's say you have a $1 million portfolio, and I don't know, maybe you expect to live for 15 more years, or you expect to need the money for 15 more years for whatever reason, and you need $100,000 for your portfolio. So you're drawing 10% of your portfolio every year. It probably isn't appropriate for you to be invested, say, 100% in stocks, because the volatility of the portfolio means you're going to have big swings. Hopefully you'll have more big swings up than down, but when the market does inevitably go down, you're still going to be taking the same amount out of your portfolio as you were when the market was going up. And you're going to be eroding capital, and it's going to make it more challenging for the portfolio to accommodate your needs. So it really depends on individual circumstances. Depends on the margin of safety that you have from your portfolio. If you have way more money than you need, well, lucky you. And you can probably do whatever makes you most comfortable without really having to worry about any real negative consequences. You might have a little bit less money than you would have otherwise, if you took a more aggressive approach. But as long as you have enough money to meet your needs, that's okay. And I'm actually going to follow that up with the second question, which is, if I was looking at retiring in 5 years, should I be looking at changing my longer timeline portfolio? I assume this is asking, should I be looking to change my portfolio to a one that's has more of a long-term focus? I think the answer to that question really is the same. Everybody's transition from retirement to from working to retirement looks different. Everybody's portfolio looks different. Some people will work part-time, will work 4 days a week, will do some consulting on the side, something like that. And some people retire when they're 60, some people retire when they're 75, some people own their homes, some people rent. There are so many different individual factors at play that need to be assessed in order to answer this question. The answer is maybe. If you take a longer perspective, longer time horizon portfolio, you'll likely do better in the long term. Of course, it's a bit of a tautology, but that's exactly what you're trying to do. You'll almost certainly have more volatility in the short run. Whether that's appropriate and whether that's the right thing for you to do, only really you can decide, and maybe a trained professional can do that too.
Yeah.
I have a joke here that I'll read. If Barry is the new bald James Bond, he will be the new Oi Oi 7. Thought that was pretty funny.
It's pretty good. That's pretty good.
And another question. This is an interesting one. Surely there's a time that you need to finally sell a business. How low can TFFI, that's TFII, go before you consider selling? And what has caused this significant drop in price?
Oh, Ernest, this is a perfect question for you to answer. When do you sell a stock, and do you let the price dictate when you sell?
Yeah, it's a really good question. We would not look at the share price to decide when we sell a stock. As the track record with Apple and TFI has shown, Apple is a great example. It's like one of the best businesses in the world, but the share price does go down 30% and sometimes even more from time to time on basically random factors. That's the thing. But then certainly we have sold stocks in the past. And what we do look at for selling a stock is when we were wrong about the quality of the business. And this obviously it's harder to tell when the share price of every company is going down. But then a good example is Activision Blizzard, which is the maker of video games like Call of Duty and Candy Crush. We bought it because we thought that they had a good market share in video games. They had a good track record of making new games that people love to play. And then what happened was that there were reports that came out that there was a really poor culture where women were mistreated. There was sexual harassment going on inside one of their businesses. And so we just felt like, even though people were still playing Call of Duty and Candy Crush, such a culture is not conducive to long-term investment success. It's not likely that they're going to end up being a very successful business 5 or 10 years into the future. This going back to Barry's slide about saying that culture is the long-term determinant of future value. So that's when we would sell a business. And it does happen. We make mistakes and things change from time to time. With regards to what has caused this significant drop in price, like obviously I hope that none of our businesses are going to fall 80% before they rebound. And I'd be shocked if that happened with any of the names that we own today. But with TFI in particular, shares are currently down about 25% from its high. And it's just basically, there's a little bit of buzz that freight rates are in for a bit of a slump after being elevated after COVID. And it's not really something that's specific to TFI. Every major trucking company is down a lot. So it's not something that we're concerned about.
Thanks, Ernest. Next question here is, when do you see the market turning around? With the uncertainty of the war in Ukraine, will the downturn just drag on?
Great question. And I hope we tried to answer that slightly in the presentation, in the sense that, of course, we don't know what the future is going to bring. It's unknowable. I tried to make the point a number of times in the presentation tonight that stocks will rebound, in our opinion, well before there's an improvement in the headlines. I know it feels, and I feel it too, and we all feel it here. I know it feels when the market's going down and it's bad news that it's just not ever going to recover. And just, why don't you guys just give in? Why don't you just sell? Why don't we wait for better times? Like we all get that action. That's a typical fight or flight response. And when we're facing the emotional concerns of the market, when we're seeing our portfolios go down, when we're seeing bad news, when we're seeing a number of the stocks that were up a lot now down, and why didn't we do something before? Like, we totally get that. And it's not something that we ignore, but we also know that our process works over the long term. And we can't let the short-term negativity or the sentiment dictate how we invest. I've seen it time and again. We've seen it time and again with clients over and over who can't take it anymore, who want to sell. Well, chances are when you're feeling that, everybody's feeling that. And everybody's feeling that and taking that action at the same time. Stock markets go down, and then there's no one left to sell. And then everything, and then at some point, that's all priced in. So I would urge all our clients once again to try and think a little bit long term, look at what the markets have done over a number of years, and hopefully that the strength will continue over the long term.
It's 8 o'clock. Barry, what do you think?
You want to take a couple more, or people want to watch the Blue Jay game?
Why don't we do one last one? Here's what wouldn't be a presentation without an individual company question. Essentially, there's a question here about what's going on with Netflix, and there's lots of competition with other streaming services. He uses a bit of a rude wording, so I'm not going to read it word for word.
Yeah. Well, so before Ernest answers that about the individual stocks, I want everybody to keep in mind that the way we manage your money is by buying 30 plus companies, and not every company is going to be up and up a lot at the same time. In fact, if you look through history, the market performance is generally only driven by a number of companies. If you missed Apple over the last 10 years and you didn't own Apple and you were buying individual stocks, your portfolio returns were abysmal. Luckily, our clients owned Apple. If you don't own Google or Microsoft over the last 10 years, you look pretty abysmal unless you knew how to time the market. So we love to speak to our clients about individual stock names and why they're down and why is this one down and that one's down. But the truth of the matter is, and I'm not trying to poo-poo it, that's the way it's going to work. We're very happy over the long term if only a handful of those 30 companies are driving your performance. There's only just one problem. We just don't know which handful is going to work. So that's why we stick with it. So Ernest, you want to talk about Netflix and then we'll finish off.
Sure. So obviously stock's down a lot from the high, and it's surprising to me too, especially because if you look at the share price today, it's about the same price as it was since before COVID. And throughout COVID, I think Netflix is kind of the ultimate COVID winner, where everybody was staying at home and looking for things to do. So if we think, and I think there's good reason to like Netflix for the future. First of all, if we take a 10,000 foot view, today in the US, which is Netflix's most mature market, is the place that they've operated in for the longest time. Cable TV still commands about 2/3 of all viewing. And I think it's not if I were betting on it, I would bet that in the next 10 years, that percentage is going to shrink towards services like Netflix and YouTube and other streaming services rather than grow. So streaming overall is still a very early innings in terms of its growth. Secondly, why I like Netflix more than, or why we like Netflix more than other streaming services is there's a lot of reasons why. The first reason is that simply put, they're the largest streaming service. And the way streaming works is that if you have the most subscribers, that means that you can spend the most money making shows for those subscribers. Netflix today has about, I think it's 200 million subscribers. So they can make the most content to show all those 200 million subscribers versus something else that maybe only has 20 million subscribers. And you can really see that in the numbers. Netflix is the only profitable streaming service that exists out there, even relative to competitors like Disney. And then lastly, I think if you study Netflix and you talk to the people that work there, they have this incredible culture of creativity where they empower their employees to create content for workers. And if you put all that together and you look at the numbers, Netflix has consistently had the lowest churn among all streaming services. So you can even ask yourself, what will it take for you to cancel Netflix? And the answer is you probably won't. Whereas if you look at the figures for streaming services like Apple TV Plus, the churn is somewhere in the 16%. People are simply signing up, watching the show that they want to watch, and then canceling. So I think Netflix is among all the names that are down in our portfolio, I would be most enthusiastic about Netflix relative to some of the other ones. I think I would say that.
Great. So it looks like we're all set. Thanks everybody for showing up.
I'm going to go home and watch Inventing Anna on Netflix. Has anybody seen that? It's highly recommended. A great story. So
I'll hand it back over to Mickey to do the rest.
Wonderful. So thank you, Barry, Ernest, and Ben. Wonderful webinar. Thank you everyone for joining us. We hope you found the webinar interesting and that we managed to convey the way we look at the markets for the long term and how we analyze specific names. The recording of this webinar will be posted on our website in case you want to watch it again or in case you want to share it with anyone else. We always like to have more new clients, and you are the one to convey that. You can reach out to any one of us if you have any specific questions about your portfolio or about any specific name that were mentioned or anything that you have in your portfolio. Have a great evening and have happy holidays, and see you soon.